Welcome to the second installment of Know What You Own. I'm your host, Eric Jefferson from Trestlebridge Capital. In this series, we explore a position in your portfolio, shed some light on what it is, how it works, and then touch on how it fits into the overall allocation based on the current market environment. So to kick things off here, I have a couple words just to keep the lawyers happy. And before I start, I want to provide some context. So as a refresher, most of you are likely familiar. Stocks represent a ownership in a company, while bonds are simply a loan. A company looking to raise capital will issue debt obligations or bonds, also referred to as fixed income, and those typically have a stated maturity and a coupon, or the amount of yield or income that is paid annually. Traditionally speaking, those coupon rates are a function of the length of the maturity of the bond, as well as the creditworthiness of that bond issuer. In normal markets, longer maturing bonds typically command a higher yield. That's a function of time value of money. And to illustrate that, we have a hypothetical yield curve here. If you look at that bottom black line, that is for the US Treasury bond. That is the benchmark index for fixed income. You can see the further to the right of the page, the longer the maturing bonds, and not surprisingly, the higher yields that they pay. Additionally, for less credit-worthy borrowers, the higher interest rates that they have to offer in order to incentivize investors is represented here in that red line. That is hypothetically the amount of yield in addition or above the US Treasury index a moderate borrower would have to offer. The yellow line there represents higher risk borrowers. Again, not surprisingly, they're going to have to offer more yield to compensate for that additional risk. One thing to keep in mind, US Treasury bonds are backed by the full faith and obligation of the US government. Those are considered risk-free. Not to suggest that they aren't volatile, which we'll discuss in a moment, but the US government has never defaulted on them. Again, they represent very little credit risk. So want to do a hypothetical example here. Let's say you're considering investing in a corporate bond that matures in 10 years from now, and that issuer has a moderate credit risk. So if we go to the current yield curve, we see that the 10-year Treasury bond, hypothetically speaking, is yielding 1.5%. If the credit spread or the amount of additional income a moderate risk issuer would have to offer in order to incentivize those investors, if that figure is 2%, we can do some very basic arithmetic and arrive at the calculation of fair market yield of that bond based upon the environment I just described would be 3.5%. So now to illustrate the impact of rising interest rates on that corporate bond, let's go back to the yield curve and say, hypothetically speaking, that interest rates increase. So the risk-free, the US Treasury rate increases by 1%. Well, here we have that same graph. Originally, 10-year US Treasury rate at 1.5. That is that bottom black line. The black line above it at 3.5 represents the 2% premium a moderate credit risk issuer would have to offer above the 1.5% benchmark rate. Well, now what happens if the benchmark rate increases 1% from 1.5 to 2.5? That is now the bottom red line there. Adding that same 2% credit risk or premium on top, a bond in a post-rising rate environment based on fair market value, bond maturing in 10 years from now with a 2% credit spread would be yielding 4.5%. So in that example, if we think about your bond currently yielding 3.5, because the fair market value is 100 basis points higher, in theory, the value of your bond is now worth less. And not surprisingly, in a rising interest rate environment, you've seen bond prices decline. That price sensitivity to changing in interest rates is referred to as duration. And to give some context, the benchmark for US bonds or fixed income is the Bloomberg US Aggregate Bond Index. That currently has a duration of 6.5 years. And that implies for every 1% move higher in interest rates, the value of the US aggregate bond index is going to decrease by approximately 6%. Now, we talked about this year being a once in a lifetime rise in interest rates. Again, if we go back to January 1st of this year, there was some talk of the Federal Reserve raising interest rates 3 or 4 times a quarter of a point each. So maybe 1.5% over the course of the year. Through the first 9 months, we have seen interest rates go from 0 to over 3%, with the expectation that they may end the year closer to 4.5%. However you cut it, interest rates have increased significantly and well over, at this point of recording in late September, over 3%. So if we think about that duration calculation, if the US aggregate has a duration of the ballpark of 6 years, not surprising that those bonds are down double digits when we think about the over 3% rise in interest rates that we've currently experienced this year. Now that makes investing in fixed income, particularly going back to January 1st of this year, very difficult. Again, with the expectation that yields are going to increase, bond prices decrease, very hard to want to own fixed income in that environment. Good news is, as our industry has evolved, issuers have found additional ways to be creative. And one of them is to entice investor capital instead of paying a set coupon, but rather paying a spread or a set percentage above a specified benchmark, with the understanding that that overall coupon paid will adjust periodically as benchmark rates fluctuate. These are referred to as floating rate bonds. And again, as interest rates move up or down, so too will the amount of income or coupon that they pay, as it will adjust in lockstep with those benchmark interest rate moves. Obviously, this works against you in an environment where interest rates decline, because at the end of the day, you are receiving less income. However, in a rising interest rate environment, this actually works in your favor. And to illustrate that point, I want to go back to the corporate bond we discussed a minute ago. If you have a fixed rate bond, again, interest rates for the US 10-year Treasury at 1.5%, corporate spread of 2%, that bond that you bought, fair market value yielding 3.5%. In a post 1% rate hike environment, you still own that bond yielding 3.5%. The fair market value, though, 4.5%. Not surprisingly, the value of your bond comes under pressure. However, by owning a floating rate bond instead, you're still receiving that 2% credit spread, but it paid above the benchmark rate of now 2.5%. And so when US Treasuries increase from 1.5% to 2.5%, that additional income now gets passed on to you as the owner of a floating rate bond. So again, when we think about the conservative portions of a portfolio, fixed income traditionally is much less volatile than stocks. However, when you have bonds very sensitive to changes in interest rates, in the dramatic rate hike that we've had this year, not surprisingly, those bonds have come under tremendous amounts of pressure. One of the ways that we've elected to position fixed income is by leveraging floating rate, which again, actually at the end of the day, works in your favor, as you, the investor, are now receiving more income on an annual basis as a function of those higher rates, which in turn protects price depreciation relative to a bond investor that owns that 3.5% bond when the benchmark fair value is significantly higher. That's all for this week. As always, I want to thank you for taking the time to tune in. If there's ever any positions or items you'd like to discuss, please don't ever hesitate to reach out. Take care.